people say we are going to run out. You suck the stuff out of the ground, and I've heard predictions about when we're going to run out for a long time.
The oil and natural gas that we rely on for 75% of our energy are simply running out.
Running out?
To believe that we're about to run out of crude oil is to believe that there will no longer be any technological innovations in production, that there will be no response to high price. I find that fairly hard to believe, and that's why we haven't run out yet.
On that the more oil we find, the more oil we find. Let's just look at the last 20 years. In 1990, U.S. proved oil reserves were about 34 billion barrels. By 2010, U.S. proved reserves were about 31 billion barrels. Those are reserves we know we can drill for and produce. Well, over that 20-year period, the U.S. produced over 50 billion barrels of oil.
Robert, Canada, as you pointed out, we get a lot of oil from Canada, but we get most of it from America, right?
Well, U.S. oil production is increasing rapidly, and so is production from Brazil. So that when it comes to the future of U.S. oil use, a lot more of it is going to be coming from right here in the Western Hemisphere, Canada, U.S., Mexico, Brazil, and less from the Middle East.
The reality is that 55% of our crude oil, more than half of it, comes from the United States. That's the number one supplier. And of the imports that we get, 52% of them total, all imports, are from Canada and Mexico. The Persian Gulf countries are responsible for only about 10% of U.S. consumption.
But people think it all comes from Saudi Arabia.
Because this entire conversation is about the Middle East, the Middle East, the Middle East. The reality is they're a small contributor to U.S. refineries.
In a year's time, a commodity that was theoretically priced according to supply and demand doubled from $69 a barrel to nearly $150, and then, in a period of just 3 months, crashed along with the stock market. So what happened? It's a complicated question, and there are lots of theories. But many people believe it was a speculative bubble, not unlike the one that caused the housing crisis, and that it had more to do with traders and speculators on Wall Street than with oil company executives or sheikhs in Saudi Arabia. To understand what happened to the price of oil, you first have to understand the way it's traded. For years, it's been bought and sold on something called the commodities futures market. Here at the New York Mercantile Exchange, it's traded alongside cotton and coffee, copper and steel by brokers who buy and sell contracts to deliver those goods at a certain price at some date in the future.
Approximately 60 to 70% of the oil contracts in the futures markets are now held by speculative entities, not by companies that need oil, not by the airlines, not by the oil companies, but by investors that are looking to make money from their speculative positions.
They don't actually take delivery of the oil.
All they do is buy the paper and hope that they can sell it for more than they paid for it before they have to take delivery.
They're trying to make money on the market for oil.
Absolutely, on the volatility that exists in the market.
So you had all these investors putting money in the futures markets, and that was driving the price up.
In a 5-year period, Masters said the amount of money institutional investors, hedge funds, and the big Wall Street banks had placed in the commodities markets went from $13 billion to $300 billion. Last year, 27 barrels of crude were being traded every day on the New York Mercantile Exchange for every 1 barrel of oil that was actually being consumed in the United States.
We believe that high energy prices are fundamentally a result of supply and demand.
A recent report out of MIT analyzing world oil production and consumption concluded that the basic fundamentals of supply and demand could not have been responsible for last year's run-up in oil prices. And Michael Masters says the U.S. Department of Energy's own statistics show that if the markets had been working properly, the price of oil should have been going down, not up.
From Q4 of 07 until the second quarter of 08, The EIA, the Energy Information Administration, said that supply went up, worldwide supply went up, and worldwide demand went down. So you have supply going up and demand going down, which generally means that price is going down. The only thing that makes sense that lifted the price was investor demand.
Masters believes the investor demand for commodities and oil futures in particular was created on Wall Street.
Are you saying that companies like Goldman Sachs and Morgan Stanley and Barclays have as much to do with the price of oil going up as Exxon or
Oh,
Shell?
absolutely. Yes. I tease people sometimes that, people say, well, who's the largest oil company in America? And they always say, well, ExxonMobil or Chevron or BP. But I'll say, no, Morgan Stanley.